So thank you very much for the introduction. So this is an ongoing project. So this is a work in progress with Silvia Lavagnini, who is at the BI Oslo. So the idea is to put together several projects that I've been doing during the recent years, starting from 2012 to 2013, essentially. So this is just a summary of different things. So the motivation for this general framework is the following. When you are working in a bank and you need to manage, for example, the counterparty credit risk of a whole portfolio of contingent claims, typically inside your portfolio, you have positions that are denominated in different currencies, mostly interest rate derivatives. And these interest rate derivatives depend on different types of interest rates. Okay, so the standard up to recent times used to be the so-called IBOR-like rates. IBOR stands for interbank offer rate, and people often put the L in front of this because there is the London interbank offer rate. But due to the recent evolutions which is happening in many different jurisdictions, now the situation is much more complicated. You have currencies areas where you still have interest rates which look like the LIBOR rate, whereas you have some other currency areas where the situation is changing or not. Question mark. Okay. So the idea is, okay, I need to set up something which captures everything, so the modeling framework will be complicated. There is no way out. So, but before we dig into mathematics, I will allow myself a very long digression concerning what is happening on the market. Okay. So the mathematics will be slightly touched at the end of the talk. So there are different things which are happening. So on the one side, I will talk about the covered interest rate parity, okay? But I will mostly talk about violations of the covered interest rate parity. Then I will refresh a bit material concerning the LIBOR bias spread, how it used to develop historically speaking. And then the LIBOR discontinuation, which is not the end of IBOR. So this is a common spread misconception that you can find in many books. Okay, I will try to put this into perspective. Okay, so let's start in simple terms. So you suppose you are an American investor. Okay, you have $1 million US. Okay, so at time zero you can do two different things. Okay, you could say, okay, I invest my $1 million US in an unsecured US deposit earning 5.30%, and then in 3 months I get this amount of cash. Okay, just put stuff in the bank account. The other thing that you can do is a composition of two things on the FX market. You do the composition of a spot transaction and a forward. Okay, so at the time zero, simultaneously, you exchange your dollars for euros, okay? And you also, at time zero, enter into an FX forward, okay? The combination of a spot transaction and an FX forward in the market is called an FX swap, okay? So if the covered interest rate parity holds, okay, then you should be indifferent between directly putting cash in your US bank account or doing these all transactions here that involves derivatives. So this is the theory that we teach in the courses, essentially. Okay. So the problem is that since 2007, so before 2007, this used to approximately hold up to a time spread of some basis points that people simply used to ignore. Okay. Now, as you can see, I put in red a not equal sign. Okay. So you cannot reconstruct the forward from the spot. And notice that here I have L standing for LIBOR, if you want, the two unsecured funding rates of the two currencies. So this no arbitrage relationship that you can find in any textbook does not hold. Okay. So what is the? It is something that you cannot ignore if you don't want to lose money. I will show you a picture later. I have time series for that. Okay. So what is the problem? The problem is that the reasoning is flawed. The reasoning that I was mentioning before is flawed because the borrowing and lending activity, which is featured in this diagram here, refers to unsecured borrowing and lending. It means that you borrow and lend and there is no guarantee. On the other side, nowadays, since 2007, virtually all interest rate derivatives are collateralized instruments. It means that when you enter a transaction into a derivative instrument, you also set up an exchange of margin calls, ideally continuously in time. Okay. And these margin calls that ideally you exchange continuously in time annihilate any counterparty risk in the derivative. So essentially, here we are comparing apples with bananas. Okay, so this is the point. Okay, so the picture is complicated if you start talking about cross-currency swaps. Because of course, if you start creating combination of forwards, you introduce essentially a cross-currency swap. What is a cross-currency swap? So FX forwards exist only for very short maturities, up to 1-2 years. Okay, if you want to do something longer, 20 years, 2 years, 5 years. Okay, you don't find forwards. You find cross-currency swaps. What is the mechanics of such a contract? It works like this. So at time zero, you exchange notionals in different currencies. Okay, I give you some dollars, you give me the correspondent amount in euros. Okay? And then at each point in time, we exchange cash flows linked to a floating interest rate like LIBOR US versus Euribor. Okay? In the end, what do? We do the last interest rate payments and then we switch back the notionals again. Okay? Okay. In formulas, this is what you obtain. So essentially, morally speaking, this is the difference between two floating rate bonds denominated in two different currencies. Okay? Because you see, here I have the domestic leg. So this is what happens at zero, the first two arrows behind, these against these. And then these are the two big arrows in the end. And these are the two exchanges of cash flows, the arrows in between. Okay? So if the covered interest rate parity were to hold, then we should observe that the two legs are at par. So present value 0. What happens? Also, this is not true. This is also systematically violated in the data that we observe. Okay, so
since 2007.
Yes. So again, approximately 0 before 2007, and no one was caring. Okay, I'm not saying that it was 0. It was 2 or 3 basis points, and okay, I don't care. That was the idea. Okay. So what happens nowadays? First of all, what one needs to do is to be precise on these things here. So previously I was just saying risk-free borrowing and lending. So I've been very imprecise so far on these objects here. The second thing that you observe from the market data is that on one of the two legs, you add a spread. Okay? So it's not Euribor, it's Euribor plus something percent. Okay? And this spread should be 0 in theory. Okay? So, and let me add, so these spreads here are always quoted against the US dollar because in the cross-currency markets, the US dollar is the king, okay? And then you always compute the spreads against the US dollar, okay? So it's the cross-currency basis between Euro and US, JPY US, Pound and US, okay? So you always add to the non-US denominated leg the spread, okay? This is how it works. And this is what you observe in the data for selected currencies. Okay, so each picture that I'm showing now is a specific currency pair. Okay, and each line here represents a different length of the cross-currency swap. We have cross-currency swap with maturity 1, 2, 3, 30 years, okay? And for each of these contracts, you have a spread, which evolves over time like this. So we clearly observe the presence of a term structure, okay? So these are, I could plot this in 3Ds, and I could make a drawing like that. Okay, so let's make a drawing. So if I had to visualize it in 3D, you would see something like this. Term structures of spreads that evolve over time, okay? So for a mathematician, this is an infinite dimensional object because it is a curve that moves over time, okay? So you don't have the stochastic evolution of a single point, you have the stochastic evolution of a whole curve, and the curve is made of infinitely many points. So it is a stochastic evolution in infinite dimension. Okay, so this is the idea. So this is at least what a mathematician sees when you look at this picture. So this is different maturities of the cross-currency swap.
Okay.
And of course, the market data are moving every day. Okay, so the spread which makes the two legs in equilibrium changes every day. So you have a time series, but of course, if you in a single day you look at cross-currency swap 1 year, 2 years, 3 years, up to 30 years, you have a curve. So it's like in the classical yield curve modeling, essentially, where you have a three-dimensional object, essentially. Okay. Okay. So this is for Euro USD. This is for Pound USD, and this is for JPY. So this cross-currency basis is always negative. It means that people prefer to borrow and lend money in US dollars, essentially. Economically speaking, this is the mean. Okay. Okay, so this is the first thing. So, okay, the covered interest parity does not hold in general, and it is something, so 60 basis point on a deal that can have a notional of 10 of millions is a significant amount of money. So you don't have to ignore this if you want to price correctly. Okay. So this is one spread, and as I mentioned, the explanation for the discrepancy was uncollateralized replication, which doesn't work, for a collateralized instrument. Okay. But this is exactly the same reasoning that everyone made when trying to explain the divergence between interbank offered rates and overnight rates, the so-called IBOR-OIS spread, where that was the focus of the whole multiple curve theory since 2007. So what I'm saying is that the first spread that I was mentioning was relatively scarcely treated in the literature, whereas this one has been the focus of a significant investigation. Okay. So of course, here I will be quite quick because the multiple curve theory here, there are many papers on this. So the idea is that essentially before 2007, people used to think that LIBOR and Euribor were risk-free rates. Okay, if you look at, I don't know, at the book by Filipovich or whatever, okay, this is what they write. Filipovich even writes the sentence that overnight rates are a better proxy for risk-free. The reality turns to be the other way around, but okay. Okay, so up to 2007, LIBOR is risk-free. Well, not really, okay? So this is what you observe at the level of the spot rates, okay? So up to 2007, sorry, I have to change the color here, bad choice. You see a very tiny spread. So overnight rates versus interbank rates do not diverge. And then we see this picture, okay? So this spread here is a measurement of the distress in the banking system, essentially. Because on the other side, the Eonia OIS 6 month, it's an artificially constructed rate for the maturity of 6 months, starting from transactions with a 1-day maturity. Okay, so this is an artificial object with maturity of 6 months that you create from overnight rates. But since you construct it from one-day loans, it has a negligible credit risk. Okay. On the other side, you have something like, okay, I give you now money, and you will give me back my money in 6 months without any guarantee. Okay. So yeah, on the one side, you are monitoring daily your loan. On the other side, only for 6 months, and this is what you observe. So spot rates diverge, but also the forward rates diverge in a significant way. So in particular, the classical replication argument for forward rates fails. Okay. So, for example, so this is essentially taken from the book of Filipovic. How do you replicate a forward? So we are sitting at time small t, okay? And then I ask myself how I can fix an interest rate for the future time interval between capital T and capital S. The standard replication argument that we teach in a classroom involves buying and selling zero coupon bonds. Okay? So the problem is, if you do this using the market data now, what do we observe? Okay? So there are some forwards for which it is still working. The forwards that are linked to the overnight curve. Okay? So if I compare for the Eonia rate, if I compare the quote, the market, the publicly observed market quote of the forward rate against the replication argument from the book of Filipovic, the difference is negligible. It still works there. Okay, so we are not teaching something which is totally wrong. But if I start looking instead at the interbank rates, Euribor, LIBOR, whatever, okay, we have again the situation where the LIBOR forward is referring to a collateralized derivative instruments without counterparty risk, whereas the replication argument involves unsecured borrowing and lending, so it is subject to credit and liquidity risk. So there is a very significant discrepancy between the market quote and the proposed replication strategy. Okay?
Yes, in fact, during the lectures, we assume
that, but okay.
Frictionless market.
Frictionless market.
But
yes.
in fact, it is now it is not why it is an assumption.
And then you ask yourself, should I teach them the whole picture or not? Yeah, this is the legitimate question because this is already quite complicated. So this is what happens on the time at the level of time series if you try to replicate things. Okay, so the blue line is so I have the blue line is an artificially computed forward using their replication strategy. Okay, whereas the green line is the quotation of the forward. Again, the forwards do not coincide. Okay. Whereas if I look at the overnight curve and I perform again the exercise of replicating the forward, I see the following. The replication and the market quotes are still okay. Okay. So it means that the forwards written on unsecured interbank rates are no longer redundant assets. Okay. So by redundant, I mean that you can artificially reconstruct them from zero coupon bonds. So they are like a new underlying. They are a new process that I need to model. Okay, and the multiple curve phenomenon is about introducing models where for a single currency area, you don't only model a single discount curves coming from the overnight rates, but then you introduce further risk factors, okay, that allows you to capture these frictions, okay? And this has been the focus of a very, very large literature body, okay? I have really no time to discuss.
this discrepancy gives you information about the risks of credit risk of.
Yes, it's a classical monitoring facility for interbank distress. Yeah. There are, so there is people who wrote on the Journal of Financial Economics, more the business, like the business school community, the Filipovic and Trolle, 2011, Journal of Financial Economics, they studied this. Okay, so there is something which does not work in the FX market. I said something that does not work in the interbank market for a single currency. And then there is a further complication over which I will not spend much time. There was a lot of discussion on these LIBOR rates, okay? And there is the ongoing topic of the LIBOR, okay? The idea is the regulator wanted to push the discontinuation of LIBOR rates, especially for the pound and the US dollar, okay? So for the pound and the US dollar, they partially succeeded, partially, I will underline partially. For the euro area and the Japanese area, we still have a LIBOR-like rate because in the euro area, there is still the Euribor rate, okay? And what has been discontinued for the euro is the Euribor. But Euribor was not computed by European banks. It was computed in London by investment banks who were borrowing and lending in euros. Okay, so this is always the source of confusion. Don't confuse Euribor with Euribor. These are two different guys. Okay, so one is computed in Brussels, if you want. The other one is computed in London. The same holds for JPY for Japan. There used to be two different JPY LIBOR rates which were computed in Europe. They are being discontinued, but there is still the JPY TIBOR, which is the interbank offer rate between banks in Tokyo. Okay, so there is no discontinuation there. For the US, what happened? For the US, USD LIBOR set for discontinuation in June this year, so in 1 month, essentially. Okay, the Federal Reserve and the Alternative Reference Rate Committee have pushed for the adoption of the Secured Overnight Funding Rate, SOFR, which is again an interest rate with a maturity of 1 day. Okay, but being secured, it means that there is a collateral. The collateral is represented by treasury bills. Okay. So if you want to borrow and lend on SOFR, you have to post collateral in the form of treasury bills. Okay. So the SOFR is also very problematic for the banking system because it does not feature a credit component. And the presence of a credit component is fundamental for the lending and borrowing activity of banks. Okay. Because when you ask money to a bank, the first thing that the bank does, okay, what is my opportunity cost for these funds? Okay, opportunity cost means if I had to ask to another bank to give me this amount of money, what is the interest rate that I should apply? So that's precisely the question which is answered by an unsecured interbank rate with a credit component. Forcing the derivative market to transition towards these overnight rates without credit components means that from a systemic point of view, inside the balance sheet of the banking system in the US, you have a discrepancy between the risk in the banking book and the derivative instruments which are meant to hedge such risk, because you have a mismatch between the two. So this is very problematic. And there is a recent paper by Darrell Duffy, so it's not me, it's someone who's in Stanford, okay, who says, okay, this is gonna create a problematic situation in the systemic crisis. Okay, so there is, and of course, since there has been a huge criticism towards this interest rate, so the market has proposed alternatives. So the American Financial Exchange has proposed the Ameribor rate, okay, which is essentially another LIBOR, and Bloomberg has introduced the BSBI index. And for these instruments, there are already derivatives that can be cleared on CME, the Chicago Mercantile Exchange, and also on London. So essentially, the market was saying SOFR is not suitable for us. Okay. So essentially, there was like a struggle between the regulator and the market here going on. Okay. So this is just the recap. Sorry, it took me a lot, but you see there are several phenomena described. Okay. And okay, how do we address things now? Where is the mathematics coming from? So the program of the, now we start with the mathematics. So the first, these are the set of requirements. So at first I need a modeling framework that allows for an arbitrary number of currencies. Okay. And this model should capture the violation of the covered interest rate parity. On the other side, once you fix a specific currency, I want to have enough flexibility in order to accommodate all the peculiarities of the interest rate market of each single currency. Okay? So, what do we do? In the first part of the paper, we revisit some computations that we did in this paper here on CFIN in 2021, where we essentially extended the valuation of collateralized claims. Okay, so we provide general pricing formulas where you can be an agent of any currency, you can receive cash flows in any currencies, and you can exchange collateral in any currencies. Okay, so we will have a general pricing formula for arbitrary configuration of these indices. Okay, so which covers everything. But in that paper, we were still working in a diffusive setting and using market completeness. So in this paper, we do it with market incompleteness and using as driving processes general semi-martingales, so jumps, whatever, Ito semi-martingales. Okay, so with differential characteristics that are absolutely continuous with respect to the Lebesgue. Okay, so a word on the indices. There are 4 different currency indices now in the story. K0 is the index of the agent. I am an agent denominated in currency K0. Okay. I can trade on assets denominated in currency K1. I can buy a US stock. I can also receive cash flow from a derivative which is denominated in JPY, and we can exchange collateral in pounds. This is why I need all these different currency indices in order to capture all possible situations. Okay? So I have to set up some notations here. I fix a time horizon, a number of economies. Every asset can pay dividends. And now look here. First interesting things. I don't have a single bank account, of course. I have as many bank accounts as there are risky assets. So I have one specific risky bank account, one specific bank account for each single risky asset. Then I still have an unsecured bank account with index 0. Okay. This is the symbol for the FX rate. So the FX rate between currency 0 and currency K. So assets are just right continuous limited semi-martingales. The dividend streams are processes of finite variation. Exchange rates are right continuous semi-martingales. And of course, the bank accounts are processes of finite variation. Okay? You can always write B equal to e to the power of minus or e to the power of integral, the usual stuff. Okay?
Sorry. You can access as many markets as the number of risky assets.
This is because we will talk about repo trading. So when you do a repurchase agreement, you borrow and lend money, but the collateral is represented by units of a risky asset. This borrowing and lending activity secured by units of a risky asset earns a specific interest rate, which is called the repo rate. And we assume that we can do this for every single risky asset. Okay? And of course, I will have a condition in order to avoid the fact that I can do long short on different cash accounts, because that will be a trivial arbitrage opportunity. Okay, I will call this the repo constraint later on, so you anticipate something that I was going to tell. So, okay, I have some notations for the risky assets. So the risky assets receive the dividends, so you just compute present values of dividends, okay? And of course, any asset can be denominated in any currency, so you can redenominate it in another currency, okay? And then you can discount them. S hat means that I am discounting a specific asset with his own cash account, okay? Tilde is instead used when I discount with the zero index asset, okay? Good. Trading strategies are big now because I have a lot of different objects in the market, one for each single currency, multiplied by the number of currencies. And then I need to introduce what I mean by a contingent claim. So I will represent a contingent claim by the set of promised cash flows of this contingent claim. It will be just a finite variation process A, which is denominated in a currency K2. Of course, you can convert it to K0, and this is what you obtain, formula 7. Okay? So it means that you obtain your cash flows in US dollar, you convert them to euro, and this is what you obtain. Okay? So this is how trading strategies start to look like. But still, please notice, this is in the unextended market without any derivative. So first, I need to make sure that the market makes sense when there are no derivatives. Okay? So this is the definition of the strategy, and this is the self-financing condition that you have in this market. You have all these covariations here between the risky assets and the exchange rates. This is what complicates things a bit. And then, of course, the usual definition of arbitrage opportunity creates something out of nothing. Okay, this is what an arbitrage is. You start with an initial endowment of 0, you end up with something which is greater or equal to 0 with probability 1, and with something strictly positive with a strictly positive probability. This is the definition that we use in financial mathematics for a free lunch. How do I guarantee that there is no free lunch in the market before I introduce the interest rates? As I said, you are not allowed to mix cash accounts, otherwise it's trivial. There is an example in T-bonds. If you have two different cash accounts with two different interest rates, just do a long short, and that's enough. Okay? Okay. So this is what we obtained in that paper in 2021. Okay. So the thing is, you can essentially, you have a martingale measure, but you don't have a universal numeraire. This is the nice thing. You have that every single asset discounted by means of his own cash account is a local martingale. So it is a multi-numeraire probability measure. Okay? So it is like a patchwork of single asset models that you glue together. Okay? This is how it works. But there is not a universal numeraire as in the classical asset pricing theory. Okay? So this is for the market without derivatives. And I said I want to drop market completeness, okay? And I want to have general semi-martingales. I don't want to have Brownian motion, okay? I want to have everything here. So how do I do it? So we do what in finance we call martingale modeling. You have already a market with a certain amount of assets, and now you introduce a further instrument. By introducing this further instrument, you should not break the martingale property. So this is what is, you can call it a consistent extension of the market. Okay?
But martingale with respect to which?
With respect to the measure that I defined properly here. So I have already all these assets here. Now I introduce a further object.
No, wait, but I understood that SI divided BI is a martingale.
Yes.
Under
QE.
All
Everyone simultaneously.
okay.
They are all every single asset has a different array.
Okay.
You have a measure which is universal, one measure of all these processes. Okay. So just introduce another one. Okay. So this is how it works. So, but the problem is now I have to talk about collateral, and this is where things start to get complicated. How does the process of the holdings of a contingent claim look like when I have it in my portfolio. This is a long-only strategy on this instrument. So you just have this guy here in your portfolio. Okay, so this is the mark-to-market of the position. Okay, then between 0 and today, I obtained the cash flows from the derivative. Second term. Oh no. Sorry. This happens sometimes. Okay, so I said mark-to-market, dividends, the cash flows that have been obtained up to now, and then there is the continuous exchange of margin calls. So C is the collateral account. Okay, so it is denominated in currency K3, which is another currency. When I receive collateral, I don't put it under my bed. I put it in the unsecured cash account, so I earn some interest. But when I receive collateral, I also have to pay the collateral rate to the person who gave me the collateral. So you have these funding spreads here. So CK3 plus is the collateral I receive. Okay, so if I receive collateral, I have to pay an interest rate to the person who borrowed me money, but the money does not stay there. I just put it in a cash account, so it is growing as well. So I have this funding spread. This is for the collateral I receive, and this is for the collateral I pay, positive and negative part. Of course, I needed to scale everything, convert everything to the currency K0. And then, of course, I have to take into account of the fact that the foreign exchange rate is moving. So there are also the oscillation of the exchange rate which are moving, and this is how the process of the cash flows look like. Okay. So this is now what do we do? We assume that this object here is a true martingale. So this is the assumption that I need to introduce. Because now I have to extend the market. Okay, this M tilde here is postulated to be a martingale. It is not a restrictive assumption at all. There are countless examples that I make. So this is now the strategy in the extended market, which involves the original market plus the extension. Okay, and if you do the math a bit, you work. This is what you obtain. This is the pricing formula for your contingent claim, which gives you cash flow in the arbitrary currency K2 and with arbitrary collateral in currency K3. Okay. Then let's say that the collateralization scheme is perfect, meaning that CK3 is equal to ST. So let's now introduce the assumption that the amount of money that you have in the collateral account is always equal, the P the T or surely, to the mark-to-market of the claim. It means that there is no counterparty risk, okay, because your collateralization is perfect. Okay, now this formula simplifies, and I obtain the perfectly collateralized case. So K0 cash flows collateralized in K0 currency. You obtain formula 17. You discount with the collateral account, which is often the overnight rate. This is the formula which is implicitly used in every paper of multiple currency. Okay, discount with Eonia. Okay, this is what they say. But then you can also have K0 cash flow collateralized in another currency. But notice, the discount rate has changed. The measure is always the same. This is the interesting thing. You change the discount factor without changing the measure. There is no change of the measure. Okay, this is nice. And then, of course, I have also the situation where you have K0 cash flow collateralized, K2 cash flow collateralized in K0. I can specialize this for the case of zero coupon bonds because I want to move to Fischer or Morton models. So I have Eonia collateralized Eonia, or Esther collateralized in Esther, because now Eonia is dead, there is Esther for the euro area. Then you have a euro zero coupon bond collateralized in the United States dollar. Okay, and then you have the United States zero coupon bond collateralized in euro. Okay, so I have several curves of discount factors. Because remember that these are always indices. So K3 changes, okay? So I don't have 2 or 3, I have several discount curves. Okay? So what we have obtained is that under the unique measure Q0, I have a multitude of discounted bonds which are simultaneously marked. Okay, this is the nice extension of our asset pricing theory that we have here. So, of course, we can define a lot of foreign measures now because I have a lot of martingales. So I can define a lot of Radon-Nikodym derivatives. So this is how I move from the domestic to the foreign pricing measure. This is almost classical. But then look, let's talk about forward probability measures. I have several because I have the domestic collateralized domestic T forward measure, which is the standard one. But then you have the K3 collateralized T forward measure. So in principle now, what I have in my head is a whole graph of probability measures, which are linked between each other by Radon-Nikodym derivatives. And this is the picture. Okay? Remember that I have a lot of currency areas. So each of these guys here is for a different currency area. So these are different spot measures, the measure that I was constructing previously. Now I can introduce for each currency denomination several forward measures. So remember that here you don't have one, but you have many because K3 changes. Okay, so you have a whole graph. I use a third graph for all these probability measures which are linked between each other. Okay. So now you could ask the question, okay, where is Hijaro-Morton coming from? Where is Hijaro? This is a talk about Hijaro-Morton, you were saying. Well, now I need to set all these things here in motion. This is where Hijaro-Morton kicks in, because so far I was just providing you with the basic framework. Okay, now I need to set the framework in motion to model it. And this is where the Hijaro-Morton methodology is important. So Hijaro-Morton Econometrica 1990, fundamental paper for interest rate modeling, but you can use it for everything. Okay, you can use it for commodities, you can use it for forward implied volatility surfaces. There is a huge literary process. So first of all, I will set in motion. First of all, I will set in motion this guy here, the domestic bond collateralized in domestic currency. Okay, and the good news is that for these zero coupon bonds here, we use the standard Hijaro-Morton framework. Only thing, the driver is not Veronaon motion, the driver is a general semi-martingale with jumps. Okay, so what you have here is just a compact restatement of the Hijaro-Morton framework, where you see I have the infinitesimal forward rate FC for the currency A0. C stands for collateral, of course. So driven by the general ethos semi-martingale X, and of course I can write a drift condition. In order to write a drift condition, I needed to recall the concept of the local exponent of a semi-martingale. The local exponent is a process psi, such that this whole thing, which is here between parentheses, is a local. Okay? So in the case of the Hijaro-Morton, it is the usual 1/2 the scalar product of the volatilities. Okay? So, and of course, it can be shown that this compensator has a Levi-Kinching form. Okay? So if you don't have jumps, you can forget about the integral. If you don't have a drift, you obtain just 1/2 beta C beta. This is the stuff that you have in the classical 1990 paper by Hijaro. Okay. Okay, so then I recall that this guy here, yes. So this is the classical Levy-Clinching formula.
This means that your jumps are quantification jumps.
No, xi is a truncation function. Okay. Then of course you need. So this is as general as it can be. Then of course, if you start putting structure, you need model things. Then of course you have to restrict yourself. Okay. So of course I reobtain the classical Higero-Morton drift condition. So this is classical Higero-Morton. Okay. Capital sigma is the time integral of this small sigma here. Okay, this is the instantaneous volatility of the instantaneous forward rate. This is the integrated volatility, but this is really the standard drift condition that we have. Okay, and now you say, okay, you told me that we have several different families of zero coupon bonds. So I could do two different things now. I could say I put a Higero-Morton, an independent Higero-Morton setting for each of these guys, or I try to think in a clever way and say, okay, they are all linked somehow between each other. And the idea that we exploit is the K0 curve is the origin of your coordinate system, okay? And then all the different bonds are modeled by means of spreads, okay? So all the different bonds are modeled by means of spreads over BK0, K0, okay? And this will allow me to isolate the infinitesimal cross-currency basis. And this will take me back to the very first slide of this talk. Let me show you how we do this. So first of all, notice what I'm doing here, formula 41. So look here, I have on the denominator the BK0, K0 for which we just constructed the Higero-Morton form. Okay. Now I have this assumption here. Of course, I need a sanity assumption. So BK0, K3 divided by DCK0, K3 should be a martingale. So this is an assumption, but it is the assumption that makes sense given the discussion that we had previously. Okay. Now I introduce this QK0, K3 as this ratio here. Okay. And this ratio here, and we also introduce a new cash account, QK0, K3. This is a cash account of this form here. So small q is like a short rate. Okay, small q is like a short rate, short tail of it. So the nice thing is that this quantity here divided by this quantity here, if this condition here holds, if that bond is a martingale, and I introduce this guy here, it turns out that this ratio here is a martingale, but not under the spot measure, but under the T forward measure. Okay?
Sorry, question.
Yeah.
This you should ask that the spreads systematically are negative for some currencies. So
this should be discussed because it's not guaranteed.
That assumption is not that obvious, no?
What assumption?
The 40. Because
40? No, 40 is just I have that these bonds here are local martingale. This is the sanity check. Otherwise, there is an arbitrage.
No, okay, yes, but it seems to me different from what we observed on the plots. So on the plots, there was a systematic consumption, a systematic negative spread.
Yes, but that spread will be captured by these tiny processes here. By this Q here that I will characterize, and by another, this guy here must be a martingale. Otherwise, there is arbitrage. So that if you want to put some econometric restrictions on the models, then you will have to work with the Higero-Morton drifted diffusion that will move these other quantities here. That's a different story. So you have to constrain your Hitcher-Morton dynamics if you want to obtain something specific. But this is the general fact. This formula 14 must be a martingale. This is not restrictive. This is just sanity of the. Okay. So this formula here. So this, if you want cross-currency multiplicative bond spread, should be martingale under the T forward measure. Okay. So what we do next is put everything together. So put together the bond model for the domestic collateralized domestic zero coupon bonds and all these spreads Q, K0, K3 for K3 ranging from 1 to L with K3 different from K0. So you see that there are several quantities now in motion simultaneously. Okay. And the character is, so this, we define the model now, put everything together. So this is a bit heavy notation, I understand. But look now, I postulate Hitcher-Morton type dynamics for the instantaneous cross-currency basis spreads. Instantaneous forward cross-currency spreads. So there are further instantaneous forward rates, okay, that are entering the story. Okay.
So capital Q is an integral of smooth.
Capital, look here. This is our element. So this is like the class. So this is the F in the this is the bond, if you want. Okay. Okay. The bond spread, yeah, precisely. So okay, we need to. What does it mean that a model like this is risk neutral? It means that the K0 bonds make sense, and all these guys here are QT martingales. So I'm just putting together the requirements that I've formulated so far here, because I need to check the sanity of the bonds and the sanity of the spreads. And we have a new drift condition. So we have the drift condition for the cross-currency basis, which is, as I said, formulated under the forward measure. But the infinitesimal characteristics of the martingale are under the spot measure. So what is the compensator under QT? Here. Okay, so when I compensate, I have to take care of the fact that there is a measure change. Okay, and this is it for the this is the characterization of the spreads. And then final tip, 2 minutes. I did not talk about the indices, the forward IBORs. So the next step, and this is still the work in progress, as I said, is how do I generalize now the IBORs rate? Okay. So I said the replication argument doesn't work. So this is how we generalize it nowadays. So this is some index, unspecified. Okay, it could be IBOR, it could be inflation, it could be anything. Okay, so this is not intrinsic to interest rate markets. You can use it also for commodities if you want. What I'm saying is we are entering a fully collateralized forward contract. Okay? And I ask myself, what is the fair value at time small t of this index in the future such that the forward today has value 0? Okay? So I define the forward as the fair fixed rate such that the forward today has value 0. Okay, so you see there is no replication argument here. Okay, and this definition is not totally new. Fabio Mercurio introduced it in 2009 for the IBOR YS, but this is much more general because now we have the different currencies. And of course, I have also all the different possible collateralizations. Depending on the collateralization policy, for a given index, I don't have a single forward. I have as many forward prices as there are collateralization policies. Okay? And of course, the future plan of the paper is to put these things in motion. Okay? Because, and the nice thing that will emerge is that depending on the choice of the collateralization policy, there is a convexity adjustment here because everything is random. So the Euribor rate collateralized in euro is not the same as the Euribor rate collateralized in dollars. There is a convexity adjustment because you see here there is the expectation of a product. Okay, and of course in the future will be set up in motion with a Hitcher-Morton setting all this year, and we will arrive at a very general formula for the cross-currency swaps, which takes into account of everything, and then we are hopefully done in 60 pages.
So the ambition is to fit at the same time all the different cards, right?
Yes, but notice that I could be old school Euribor, could be SOFR, could be gas, Brent, whatever. Okay, so so for example, if you look at the Bloomberg, at the screen of a broker, okay, they wrote something tiny. Okay, these are collateralized in US dollars. So for example, in the FX market, the dominating currency is the US dollar. Okay. Then there is a big discussion: how do you recover the collateralized quotes for the other currencies? Because then, if you think a bit, you realize that there is a huge market incompleteness here behind the scenes. Because I told you that the forwards depend on the collateralization scheme. So if I now need the forward of the US collateralized in euro, sometimes there is no market instruments that allows you to obtain this information. Okay, so this is a very interesting topic. Yeah. So thank you very much for your attention. Sorry, it was an experiment today.
Thank you so much.
Collaboration.